This chart shows GDP growth for each half of the year, going back to 2022, all positive. But here's what happens when you take away information processing equipment and software. Those numbers get a lot smaller. GDP growth for the first half of 2025 falls from over 2% down to just 0.1%. That's right, without data center investment, US GDP growth in the first half of 2025 was near recession territory. These calculations were done by Harvard economist Jason Furman, who also pointed out investment in information processing equipment and software is 4% of GDP, but it was responsible for 92% of GDP growth in the first half of this year. This has raised some big questions about just how much big-ticket spending by large companies could be gussying up an ailing economy. This is the contribution to US GDP growth from consumer spending by quarter going back to 2022. You can see it's sharply tailed off since Q4 of 2024, but here's the kicker. This other line is the contribution to GDP growth from investment in IT equipment, largely data centers, and it's risen quite rapidly over the first half of 2025. Fixed investment into IT equipment and software rose by nearly 30% year on year in the first half of 2025, up from just 5% growth in the second half of 2024. And much of this is going to build massive data centers, such as OpenAI's Project Stargate. Global spending on data centers is projected to grow to $3 trillion by 2028, and that huge wave of spending may be disguising some underlying issues with the economy. And for the first time ever in 2025, spending on data center construction made up a bigger chunk of US GDP growth than consumer spending. And this chart drives home just how much the economy has transformed over the past half decade. Just 4 years ago, US companies spent 7 times more money constructing offices than data centers. Today, they're nearly 1 to 1. And that surge in data center construction reveals an unprecedented large-cap shopping spree that's driving the economy today. This chart shows total capital expenditure by the top 10 spenders as a share of the 2,000 largest US companies. This figure has rarely exceeded 25% since 2000, but has skyrocketed in 2025 and now sits around 32%. That means the top 10 spenders are on a shopping spree and account for nearly a third of all capex spending. This could be viewed as justifiable investment, building a floor for an innovative next-gen tech that's generating a tremendous amount of wealth. And it is doing that. AI company revenues are climbing fast. OpenAI's annualized revenue hit $13 billion this year. Anthropic is up to $7 billion. But if you look a bit closer, the floor under this AI boom and the rest of the economy could be shakier than they seem. Just look at how these data centers are being funded. Debt. Bond issued by big AI tech companies has risen from just over $10 billion early in 2025 up to nearly $40 billion. Amazon, Alphabet, Meta, and Oracle have issued nearly $90 billion in new bonds just since September, more than they issued over the previous 40 months. Meta has tapped $29 billion in private credit for an AI data center project, proving that even the richest companies have burned through enough available cash to start leveraging debt. Oracle's default risk has sharply increased to a 3-year high, and it reflects wider concern across the sector. The huge wave of debt to fund data centers has made some investors wary of a funding gap and default risk across the sector. Even with all these new data center projects in the pipeline, they may not do much to keep growing the economy. That's because they're capital intensive, but not labor intensive. For example, about 1,500 people are working on building OpenAI's Project Stargate data center, but once the concrete is poured and the server fans start whirring in mid-2026, only about 100 people will work there full-time. That means all that investment in data infrastructure will not return a proportional number of jobs to shore up the labor market, and it really needs shoring up right now. Job cuts are on the rise and rose sharply in October to over 153,000 lost jobs, up from 54,000 in September. And AI was one of the biggest reasons for those job cuts in October, with 31,000 jobs lost due to AI. And year to date, AI has been cited as the 6th most common reason for job cuts in the US, accounting for nearly 50,000 jobs. And it's not just that AI programs are directly replacing workers. All that spending going towards data center construction is money diverted away from other investments, including hiring. This shows no sign of slowing down. Microsoft, Alphabet, Meta, and Amazon expect their 2025 capex total to be around $370 billion, and for that to keep rising next year. At Capital.com, we'll keep you updated on AI stocks and the most important news about big tech investment. Hit like and subscribe to stay tuned. Thanks for watching.